Welcome to the PJ Finance Show. Today we will discuss transmission and limitations of monetary policy.
Hello?
Phoebe, I have questions regarding the transmission of monetary policy. Are you free to help?
Sure, just send them my way and I'll try my best to answer them since you helped me so much about country investment last time.
Glad it helps.
First, let me explain the types of money supply. M1 includes checking deposit, currency and traveler's checks, while M2 includes money market mutual funds and other deposits, saving deposits, as well as time deposits. Moving on to the equation. MV equals PT equals nominal GDP, which means that money supply multiplied by velocity equals to price multiplied by transactions equals to nominal GDP.
Usually, if the central bank wants to inflate the economy, all they need to do is lower interest rates and increase money supply. Same concept applies to deflating the economy too, they raise interest rates.
That's correct. However, it is more complicated than that. When money supply is increased, nominal GDP goes up as well, but according to this equation, prices might increase with little or no increase in transactions.
I see. Higher money supply leads to higher nominal GDP. Higher nominal GDP can be due to more transactions, i.e. greater economic activity, which is good. But when higher nominal GDP comes from more price increase, which is higher inflation, then it is a bad outcome.
In a country where the central bank has strong credibility against fighting inflation, increasing money supply will induce more transactions. But when the central bank has no credibility, it will cause inflation. From our previous discussion, we assumed that velocity is stable. But if velocity is decreasing significantly when money supply is insufficient, the economy would contract.
So this is what they often referred to as pushing on a string. Phoebe, we talked a lot about velocity, but what exactly is the concept of velocity?
Let me show velocity in a simple idea. It's how often you open up your wallet to spend money or to receive income.
I see. So we can assume that higher money supply creates inflation.
Not exactly. This graph suggests otherwise. From what we observe here, money velocity has a better correlation with inflation rate. The idea that too much money chasing too few goods might be replaced by faster money turnover chasing too few goods.
Now I can see why the V in MV equals PT is important.
Let me show you a diagram to sum it up easily. This diagram shows us the factors in between inflation rate and interest rate. When the Federal Reserve System changes the fund rates, it will affect the money market interest rate immediately.
It will also affect money credit, asset prices, bank rates as well.
Yes, this in turn affects the supply and demand in goods and labor markets, the domestic and import prices through exchange rate.
So this is how the price development, or inflation rate, is affected overall.
There are also factors that are outside of the central bank's control too. For example, changes in risk premia, which is equity market premium, corporate bond spread and yield curve. There are also changes in bank capital, in the global economy, fiscal policy and commodity prices as well.
I feel sad. So, there are limits to the power of monetary policies. There are factors beyond the control of the central bank. By the way, is inflation targeting a good idea?
Inflation targeting has a lot of pros and cons. First of all, it makes it clear that the Fed cannot affect real GDP in the long run. Second, it is easier for firms and households to form expectations about future inflation, improving their planning of how much raw materials to buy at roughly what prices and how to set prices for their sales in the near future. It also promoted Fed accountability, which provides a key performance indicator against which performance can be measured.
These are all very reasonable.
Yes, but inflation targeting also reduces the Fed's flexibility to address, and accountability for other policy goals, namely economic growth. If the Fed is too fixated with fighting inflation, then they may not want to stimulate the economy and fear that inflation may flare up.
In that case, inflation targeting also assumes the Fed can correctly forecast inflation rates, which may not be true. So, which inflation rate does the Fed actually pay attention to?
According to this chart, CPI is too volatile and probably overstates inflation. So the Fed had used the PCE, Personal Consumption Expenditures, Index, which is a broad price index similar to the GDP deflator. However, it has changed to Core PCE since 2004.
What is Core PCE?
It is PCE without food and energy prices. It is more stable compared to CPI and Core CPI too. The Fed believes it estimates true long-run inflation better.
I see. Thanks, Phoebe. Now I understand inflation rate better. You earn yourself a badge.
I think you've been playing too many games recently.
Thank you for watching. This presentation on transmission and limitations of monetary policy is brought to you by the PJ Finance Show.